Hi everybody, welcome back to my channel. This is Oliver Wiedmaier at Ollie_Allcaps on Twitter, founder of Voyage Trading Group. Before we get started with the market review, I'm no longer on Discord. I still have the Discord channel, but I'm not going to be as active on it, so I'm no longer going to be providing the paid service. I have moved over to Substack. I'm going to be giving out free educational articles and free market updates, but no longer will I be offering the coaching service for the month-to-month rate. If you are interested in one-on-one coaching, please reach out. I will be offering that, but from the month-to-month daily mentoring, I can't give the attention that I need on it right now. So I'm closing that down and have been moved over to Substack. So I'll have that down in the description, but let's take a look at the market. The MMA chart, you can see the red moving averages, which is the faster moving averages, are almost all above the blue slower moving averages. And what we want to see on an uptrend is some space in between here. Definitely want to see space in between all of the red and all of the blues, but what we want to see is the blue lines start to open up. And so you can see when we are in a trending market, like we were here, November 2021, there is some space in between the red and the blue, but also there's some space between the blue. We haven't been able to really get that in 2022 bear market, and you can see we got a little bit here, but as they started opening up, the red moving averages were turning down, which was a clear indication that we were going to break through again, which we did. And so monitoring this, what makes this a little bit different is you can see as we are coming off the bottom here, we are having 10-day consecutive net highs versus when we were trying to make the bottom here in November. We did not have 10 days net high, and we haven't had 10 days net high since July of 2022. This was a really strong rally. And then before that was March of 2022. Wasn't that strong a rally, but the net highs did prevail. So that's what we're looking at. We're looking at a much stronger rally off the bottom here than we did when we were trying to make the bottom in October. Another thing that is different between January 2023 and the October, November is the advanced decline line. You can see that we are in overbought zone, but in a strong bull market, we want to stay in overbought, which is a good sign. If we take a look at the SPY in a candle chart, we can see that when we made this 6-day follow through, so we'll count it out. So it's starting from this December 28th. We made this low here of 376.42, and then you count 6 days. 1, 2, 3, 4, 5. This was a 6-day follow through. You can see by the volume here. Then we made higher high, rejected, held 385, and then we have preceded 3 up days since then. And this is really important here. This 393 level. I wanted to see it come test this level, right? Because obviously there was a big seller here, a lot of selling pressure here. And so if we were able to hold this level on the first stress test, then that would mean that the selling pressure is off. And so that's very good. And we want to see it continue. Still have a long way to go. Looking at 427. And we also just want to see some sideways action for the 200-day moving average to kind of flatten out a bit. You can see how choppy the 50-day is. So we want to see the 50-day moving average turn up some. We want to see it go like that. And we want to see the 200-day moving average go like that. And then eventually turn back up. And then they can trend together. Hopefully the 50-day would trend higher. and more steep, while the 200-day trend something like that. And then of course you want to see the 8 EMA, 9 EMA, 21 EMA get more steep like that. So that's what I'm looking at. We're going to take a look at the Qs. Okay, we see in the NASDAQ that we have not traded above the 200-day moving average, but the same thing, I want to see the 200-day moving average flatten out like this and then start to turn up. At the same time, I want to see the 50-day moving average cross above, make that golden cross here, and then we need to work our way to 332. That is when we'll get out of stage 1 and we will become a stage 2 market. So that's exactly what we want to see. We're looking for a golden cross. Could take a couple weeks, but essentially we want to see the moving averages flatten out and then start to turn up. Let's take a look at my risk model. We can see very quickly that the prices above moving average. However, the moving averages are not stacked in our favor. So what we want to see is we want to see the 5 above the 10 above the 21, 21 above the 50, and then that 50 200-day cross, which will be that golden cross, is the last piece of the puzzle. Right now, my risk model has flipped to green. We are at a 12. Growth stocks are holding up. They're moving out. The indices are all trading above their key moving averages, and the breadth has improved significantly. VIX is at a 18. We are well over 100 new highs 10 days in a row, or net highs 10 days in a row. I do want to see the number of stocks above the 200-day moving average much higher. I'd like to see it 70, close to 70, 75%. And the number of stocks above 50-day moving average, I would like to see that closer to 90%. So that's kind of the last piece of the puzzle for me to get extremely aggressive. For now, I'm still taking it very easy, still very day trader-esque, but I am looking to dollar cost average into a few names. I think dollar cost averaging into biotech, if we can get out of this. Again, this is kind of that bottoming process here, but I think we've made kind of this cup and handle here, and so I think that, let's see here, I think that if we and then we can have this little handle here. But we might drift down a little bit further before taking out that 170 level. But I think 170 is the key here. Before we start marching up higher, we do see that the 200-day moving average has flattened out and is slightly up. That 50-day moving average is awfully steep. That's the green. So that's exactly what we want to see. So I'm a buyer above 170 at any sort of support. So if it shoots straight up at 170, I won't buy. I need to buy on some sort of support. But after 170, I have the green light to buy. XLE is another sector, of course, I'm looking at, but I need it to get above 93. And of course, we can drift sideways. We can hit that 93 and then, reject it. But again, this is kind of one of these cup and handle looking patterns. Here would be the cup, and then you have your handle here, making that VCP action. So this is exactly what you want to see. This might need a little bit more time. We still have a little bit of way between 90 and 93, but above 93, I like it. Caterpillar, this is a super strong name. We can see that we came out of this long base. And so if this can come back to some moving averages, perhaps the 20 moving average, even if we get a test of the 50-day, which I doubt we will, but any sort of pause here, I think I'll be a buyer. Let's take a look at, here's some sector strength. We see we are positive quarter, positive on the month, positive on the week for the majority of these. But basic materials is definitely taking the lead right now. We can see that let's see, performance year to date. Here are the best performing basic materials this year. If you want to look at it for the 365, the not the year to date, but the year 12 months. Here are a few names. These are going to be really strong performance, and if they continue this performance, then they could become big winners for this year. Last thing I want to look at is a heat map. So when looking at heat maps, I want to look at performance farther out. So I don't want to look at 1 week performance or 1 month performance. I want to see what stocks have been outperforming on a 6 month and longer basis. So we can see financials have been, energy has been, a lot of industrials, some healthcare. But but you look at the big tech, these are not going to be the big winners moving forward. So this is a really great visual. Semiconductors, I mean, NVDA is only up 7% in 6 months when you got something like Exxon that's up 33%, or something like Lily's up 9%, right? So there's things that have been outperforming, and that's where you want to put your money. Not something like an Apple that's down 10%, or even Google's down almost 18%. Let's look at the 1 year performance. There's gonna be a lot of red. So here you have a better idea. For 1 year, you have energy and you have healthcare, and some aerospace defense, and that's basically it. So this is where you're gonna want to look. Unbelievable. Exxon's up 60% over the past year, while Microsoft, Apple, Google, Amazon down 40%, Tesla down 66%. So this is where the strength is. This is where the money's been, and the money's been flowing. And so yes, you want to look at new future growth, but names like Johnson and Johnson and AbbVie and Chevron, they're not sexy names, but clearly this is telling a different story, because you have Apple and Google, sexy names. They're down. So this is what you want to look at when you are doing your deep dive and looking at your future of 2023. It might not be high tech. It might be other areas. We're seeing some great performance in John Deere, Lockheed Martin, General Dynamics, even McDonald's, right? McDonald's positive 3%. So more value, more industrial type healthcare, things like that. So appreciate you guys watching. If you have any questions, please hit me up on Twitter.